Good evening, everyone. Thank you for joining our webinar today. Hope every one of you are doing well. I am your MC today. My name is Huijun from Phillip Futures Marketing. If you have any questions, please leave your questions in the question box and we will try to answer as much questions as we could during Q&A session. Today's webinar is about risks and money management principles for trading CFDs, which is the last module from our CFD webinar series, featuring professional trader and managing partner of Asmodeus Trading Group, Mr. David Low. Just a quick survey here. Today is our Module 3 session, so did you join our Module 1 and Module 2 session by Mr. David Low previously? Let me launch a poll here to give me some response here. Okay, thank you very much. I can see some response here. So in this session here, we will be sharing about critical understanding leverage and how to use it wisely. The second one is learn stop loss and profit taking strategies. The third one is how to determine the optimal trading exposure to ensure long-term success. The last one is recognizing when to increase and when to decrease exposure. Before we invite our speaker, please allow me to introduce our company. As usual, I need to emphasize on our disclaimer where this presentation has not been reviewed by the Securities Commission Malaysia and is provided to you for general information only and does not constitute any recommendation. We are not liable for any losses arising based on this information. Investments are subject to investment risks. Therefore, you shall seek advice from qualified advisor before making any investment decision. CFDs may not be suitable for clients whose investment objective is preservation of capital and or whose risk tolerance is low. Clients are advised to understand the nature and risks involved in margin trading. Phillip Futures is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. It is incorporated on 7th of October 1995. Our headquarters is in KL and branches distributed across Malaysia, such as Kota Damansara, Malacca, Penang, Johor, Kuching, and also our opening of new branch in Sibo, Sarawak, East Malaysia. Other than that, Phillip Futures is a trading participant of Bursa Malaysia Derivative Berhad, clearing participant of Bursa Malaysia Derivative Clearing Berhad, and also holder of Capital Market Services License, known as CMSL. Phillip Futures is the first to provide an online trading platform for both local and foreign products. Our network is distributed around the world besides Malaysia in Asian countries such as Singapore, China, and Japan, and also European and American countries such as US, UK, and France. For futures, we offer products from different exchanges such as Bursa Malaysia, Singapore Exchange, CME, Seaboard, COMEX, NYMEX, and more. With our strength of global coverage, clients able to trade both local and foreign products under the same platform. On the other hand, for CFD, currently we offer Bursa Malaysia Top 100 Stocks CFD for the time being. With our strength of global network, it enables us to provide global coverage. We provide one-stop solution for your business. We offer various kinds of product categories for futures, such as interest rate futures, US Treasury bond, metal futures such as gold and silver, agricultural futures such as crude palm oil, soybeans, energy futures such as crude oil, gasoline, and natural gas, index futures such as Kuala Lumpur, KLCI Kuala Lumpur Composite Index and Dow Jones, whereas for CFD we offer Bursa Malaysia Top 100 Stocks CFD. Next, why should you choose Phillip? First of all, we provide advisory service such as product enquiries. Next, we offer a wide array of products for futures that enable clients to trade both local and foreign products. Other than that, we send out latest market news and commentaries to clients every day through email for references. Lastly, our headquarters has 24 hours booking and execution support. This is important for clients who trade foreign futures, and also dealers can assist your enquiries anytime. No matter you are our clients or not, we offer free one-to-one coaching sessions, free seminars and webinars, and free account opening. For free one-to-one coaching sessions, the key topics we are focusing on are introduction to futures or CFD trading, product knowledge, platform coaching, and charting system. Another quick survey here. Anyone of you interested to our CFD coaching session? Let me launch a poll here to give us some response. Okay, thank you for the responses. If you're interested, then we will contact you for the appointment of one-to-one coaching session. We conduct free seminars and webinars regularly, but since we do not organize seminars at the moment, we focus to provide more live webinars with different topics for you to join. For upcoming webinars, we have Exploring Trading Opportunities for Base Metals in 2020 Part 1 on 28th of July, Tuesday, is from 7 to 8 p.m. For August webinars, we will update on our website, so stay tuned. So if you're interested to our webinars, so just feel free to scan. So you will receive more information and events updates. For free account opening, you will receive complimentary mobile and desktop platform at no cost and access to a wide array of products, including global futures, commodities, energy, interest rate, and metals. Great news is we have successfully launched the first futures trading online account opening in Malaysia. You can now open futures trading account online with no hassle. If you wish to open futures trading account online, feel free to visit our website or scan this QR code that will directly link you to the form. If you need guidance on online account opening, please do not hesitate to contact us. The platform for futures trading is Phillip Nova, which commonly used by our clients to access local and foreign products on desktop and mobile. It is web-based and user-friendly where you can trade anywhere and anytime. The platform for CFD trading is Phillip CFD Trade, where you can access Bursa Malaysia Top 100 Stocks CFD for free. We have three features. The first one is advanced order type, such as stop limit give you the flexibility to better deal with changing market conditions. The second one is live charting, bringing together the best of intraday and historical charting. Live chart showcases historical data of up to 20 years, as well as to the minute live data for top 100 stocks listed under Bursa Malaysia. The last one is order and price alerts. Stock prices can quickly change with time. By setting up an alert, you will get notified as soon as the price goes up or down. This helps you make a better decision on when to open or close a trade. Also, get customizable real-time updates on your desktop or email for your orders with our live order notifications. The long-awaiting promotions are here. To visit our website for more complete details and terms and conditions. The latest ongoing promotion is CFD Bonanza Campaign 2020, which valid from 50th of June to 50th of September 2020. Redeem your free trades up to 1,500 ringgit when you open a CFD account with Phillip Futures today for free. In addition, new clients and existing clients are entitled to enjoy cash rebates up to 1,500 every month once traded Bursa Top 100 share CFD with us during the promotion period. Register now by scanning the QR code to leave your contact details. Our representative will then contact you as soon as possible. Our next promotion is Phillip Futures All-Star Rewards, which valid from 1st June to 31st of July 2020. Trade Bursa FKLI and SCPO and be one of our top 3 traders to receive cash rewards of up to 588 ringgit. In addition, new clients will be eligible for a one-time cash reward of 50 ringgit when a minimum of 5 lots of Bursa FKLI and or SCPO are traded during the promotion period. You may scan the QR code for more information and register to the promotion before too late. There are many ways for you to keep in touch with us. You may connect with us now on Facebook, LinkedIn, and YouTube by searching Phillip Futures Sdn Bhd and Telegram by searching Phillip Futures. Do like or subscribe our page if you haven't. We are consistently update on our promotion, events, announcement, and market news. Our recorded webinars will be uploaded on our YouTube channel too. If you have any queries, please do not hesitate to contact us either through calls, emails, website live chat, or Facebook Messenger. Our representative will contact you as soon as possible. Lastly, let me introduce our speaker today, Mr. David Loh. David Loh is currently a full-time trader and managing partner of Asmodeus Trading Group Plc, a consultancy specializing in providing bespoke trading strategies and coaching for private and corporate clients in the equity, commodity, derivative markets. He has 24 years of experience in Malaysian listed derivative industries, having held leadership positions in futures broking divisions of major investment banks in Malaysia. He is also the immediate past president of the Malaysian Futures Broker Association, MFBA, from 2018 to 2019. Since 2000, David has spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivatives as well as foreign futures markets. This includes live market trading sessions and webinars. Alright, without further ado, let's invite Mr. David Loh for his sharing.
Okay, thank you very much, Hui Chen. Before we get into the webinar proper, let me pull up my slides, and then just to check the audio, I'm going to put up a poll to make sure that everybody is hearing me loud and clear. So do respond to the poll to see is everybody connected properly to audio. Okay, it looks like I have a very good connection here. 96%, 4% can't hear me. Okay, just fiddle a bit with your audio settings and hopefully that get fixed. Okay. Okay, I hope you can see my screen. Now, before we start, welcome everybody to this webinar. This is the third in the 3 series CFD webinar for trading stock CFDs. And I'd like to first and foremost thank you, Phillip Futures Malaysia Sdn Bhd, for the invitation to share ideas on how to trade stock CFDs. So before we go on, just to get a feel of, you see, the current flavor in the stock market is of course very evident. A lot of activity in the rubber gloves stocks. Just to get a feel of the people we have here, 100 over people in this webinar. I'll just launch this poll just to get a feel of how many of you have positions in rubber counters. Anybody? We have like about 10% of our audience having positions in rubber glove stocks. Okay, that's good. How about this view? Okay, everybody has a view. The view of, are you bullish or bearish on rubber glove stocks? This is interesting. Feel free to give your opinions. Okay, we have 64% bullish, 36% bearish. Yeah, it's staying around there. 64% bullish and 30, no, 66. Oh, okay. As time goes by, more people get bullish. All right. Yeah, it is actually getting from 64% to 68%. So it's settled at 68% bullish and 32% bearish. Okay, thank you for your responses. Okay, it's very interesting to talk a bit about this rubber stocks, whoever is bullish or bearish. Well, it actually depends on when you ask that question. Last week, when I was during the weekend, when I was having dinners with friends, one dinner with friends and one dinner with relatives, a lot of them are very, very bullish, right? And a lot of them as well, who I thought don't trade stocks or don't invest in stocks, also are talking about rubber stock counters. So it's very interesting to see the dynamics. Okay, of course, if you look at the press, if you read the Edge markets and you read the business news in the newspapers, you see a lot of analysts as well having projections, rather positive projections on rubber stocks. Now, if you have attended our last, especially the second module of the CFD trading CFD series, you would have perhaps being able to make a technical view as well, because we shared during the second modules how to read charts and how to read the trends. So perhaps because more than half of you actually have attended at least one of the last two modules, and in the second module, you may be able now to actually tell the trend of the market. But it also depends on which time frame you're looking at. Are you looking at a daily trend, or are you looking at a weekly trend, or even are you looking at an intraday trend? So these are very interesting things to monitor and look at. Very interesting stocks. Also, of course, the last 2 days have been very volatile as well. So it's an interesting case study. Later, we'll go into some of these stocks and talk about it in accordance to the topic today, which is risk and money management principles for trading CFDs. This is a very, very important topic, and topic very close to my heart, because I feel that in terms of trading success, a lot of people concentrate on finding a method to analyze when to buy and when to sell. That is, of course, very, very important. But more important, even more important, that is the ability to know how to manage your risk and actually know how to manage your positions. And today, the topic will cover this particular area. So let's get into it. All right, so this is what you will learn tonight. We'll talk about the critical understanding of leverage and how to use it wisely. This is very, very important when it comes to CFD trading, which is a leverage product. Okay, so this is key to understand when you want to trade CFDs. We'll talk about stop loss and profit-taking strategies. We talk about how to determine the optimal trading exposure, how much to trade, how much to risk in order to have long-term success in trading stock CFDs. And we also need to know how to recognize when to increase your exposure and when to decrease your exposure. So these are the things that you will learn this evening in this webinar. But firstly, a disclaimer. spend a bit of time to read this disclaimer. You have to be a bit of a speed reader as well. Okay, I hope you have read that. Let's move on. Okay, a quick recap on CFD modules 2, okay, which was strategies for trading stocks. We spoke about how to pick stocks based on Volare, which is volume, volatility, liquidity, and range. So in order to trade stock CFDs, you must have stocks which have enough volume, okay, enough, of course, volatility. You know, we want to buy stock CFDs that actually can move. You need liquidity so that can get in and out of the particular stock CFD. And we also talk about range. So the particular stock must have enough range, especially if you are day trading stock CFDs, right? So we spoke about the different type of strategy, okay, and we looked at the different time frames and different time frames in your charts, whether you're using 15 minutes, hourly charts, or daily charts. It will depend, okay, on your trading style and whether you're a day trader, you're a swing trader, you're a position trader, or you only trade for, say, T plus 5 kind of period, right? We also spoke about how to read the trend and how to spot the reversal patterns. You see both the reversal patterns here actually on the right of the screen. Okay, the top one is the uptrend turning into a downtrend, and the bottom picture is where the downtrend turns into an uptrend. Okay, and those are the critical recognitions of the reversal points. So it's very important to recognize that. Okay, and we also went to how to identify entries and exit with ABC charting strategy. We will cover a bit of the charting strategy today in relation to where to put your stop losses and where to put your profit taking exit. Right, so let's move on. For your information, for those of you who like to review the modules 1 and modules 2, it's already up on the YouTube. Please search for Phillip Futures Sdn Bhd and the list of videos there. You can see modules 1 and modules 2, right? For those who need to review or for those who didn't join us in the last 2 sessions. So let's move on to today's topic. In trading CFDs, the most important thing you need to understand is how to manage this thing called leverage. Leverage is what we call a double-edged sword. Okay, what is a double-edged sword? A double-edged sword is basically a sword that can, or a knife that can cut 2 ways, right? Most of the knives in the kitchen, it only has a sharp edge on one side of the knife, right? But in terms of a double-edged sword, that means that this particular knife can cut both ways, right? And most of the risk from trading CFDs or even things like futures, leverage instruments, inherently lies in the trader not understanding the negative effects of leverage, right? So the traders who don't understand this particular aspect of leverage, okay, and how to manage it, those are the traders who will get hurt, right? So managing the risk is the most crucial key to successful trading in CFDs, right? So in terms of leverage, what you don't know can actually kill you. So this is a very important concept to understand, leverage, right? CFDs are traded on margins, and that's where leverage comes from, right? Margins are the minimum deposits required for holding a position, and these are relatively small percentage of the value of the instrument. On the right, you can see on the table, right? These are the recommended minimum margins by the Securities Commission for single stock CFDs or index CFDs. Take, for example, for index stocks CFDs, right? The minimum margin is 10%. Okay, and for the non-index stocks, it's 20%, and for index CFDs, is 5%. So in terms of the lower part of the table, you see if the minimum margin is 20%, the leverage factor is 5 times. And if the minimum margin is 5%, the leverage is 20 times, right? What is this leverage factor? It means that for the underlying movement, okay, say for example, you buy a particular stock A, and the underlying movement move 10%, right? If your minimum margin is 10%, okay, that means you have a leverage of 10 times, right? You can see here, if you 10%, okay, and 10 times, which means that if the underlying stock moves by 10%, your account will move 10 times it in terms of the margins, right? So if it moves 10%, that means it moves 100% in terms of your movement, in terms of your margins, right? So be very, very careful, okay? If you don't manage your positions properly, the effects of leverage can work against you quite quickly, right? And we've been emphasizing that in modules 1 and 2 as well, that you need to take care of this particular feature of trading. So margin is the one that enables leverage. We move on. Okay, so know where to land before you take off. Now, if you are captain or pilot of a plane, okay, before you even take off, you actually should know your plan to land. Okay, where you're gonna land, what are the conditions that you're landing, right? Because good trading is all about exits, right? How you get out. Okay, where and how you land is critical in any flight plan if you are a pilot, right? So as the captain of your own trading, right, you must have a plan on how you're going to land before you are even up in the air. That means before you take a trade or go into a trade, okay, you have to ensure that you actually know where you're going to exit, okay, if you have a profit, and where you're going to exit if actually things don't go well for you, right? And one of the quotes that I like is, money is not made when you buy, it is made when you sell, right? And that's very, very true. So any monkey, yeah, even a monkey can key in a trade, you know, he press a few buttons, he can actually go into a trade, okay? But the real money is made or lost, okay, when you exit it. So the critical is very critical to have an exit strategy. And there are a few types of exits, of course. There are exits when things don't look good, you have stop losses, okay? And when things go well for you, profit taking. And when things don't really go anywhere, also you must find an opportunity to have an exit if things don't go anywhere, right? So let's go into detail on the various exits. Now, the most important exit of all to have, okay, is your stop loss. And this is your safety airbag, right? This is like when you're driving a car, you have this safety airbag, right? And I put it in red there. This is one of my cardinal rules when trading, right? Do not trade if you do not have a defined stop loss strategy. Okay, this is very important. It means if you don't have this safety airbag, right, it's risky to be trading in a leveraged product like CFDs, right? As you can see, if a market goes against you by 10%, right, in a if you are leveraged by 10 times, you will have lost 100% of your capital, right? So do not trade if you do not have a defined stop loss strategy, right? That means before you trade, you need to have your strategy for having a stop loss already in place. Okay, and one of these things is because not all trades can be winners, right? It's not like we are so accurate every time that we go into a trade, we will always come out as a winner. Not all trades we will be winners. So the stop loss strategy actually aims to preserve our capital for the winners that will come, right? So immediately put a stop loss order every time you enter the market. Okay. In order to do that, of course, you will need to know where to put a stop loss, how you're going to put the stop loss, right? So you need to know your exit even before you start to enter any trades, right? And in terms of stops, a general guide on to put a stop is where the loss does not exceed 2 to 5% of your account equity. That's the basic guideline, right? In order to be sustainable, right, in the long run, don't take a stop loss that exceed 2 to 5% of your account. Okay, that's for the long term, right? And typically there are a few types of stops. there's what we call a fixed dollar stop, a percentage of price stop, and there are technical stops. And the explanation is on the right side. Okay, fixed dollar stops is basically a fixed ringgit protective stop. Okay, you use a fixed value which is applied per share. For example, if you say that I have a stop loss size of 5 ringgit, okay, it means that the stop price is calculated so that if the price is hit, the loss will be 5 ringgit per share CFD. Okay, of course, $5 per share CFD is quite a large loss, right? Depending on the size and what is your entry price. Okay, perhaps your losses may be, your stop losses in terms of fixed dollar may be something like 30 cents or even 50 cents, depending on what stock you're trading. Okay, but in terms of fixed dollar or fixed ringgit stops, is basically a stop defined by the ringgit, right? And then you have a percentage price protective stop. Okay, which is you place a percentage protective stop set at the percentage of the entry price. Okay, an example is, let's say for example, if your entry price is 25, okay, so this is a rather big stop, right? And you have a 5% protective stop, okay, which replace 1.25% points from the entry of the long trade, right? So as the prices continue to move forward, you would have that particular protective stop. If you're going to trail it, okay, later we'll talk about trailing the stops. You can change it as it moves, right? Even for the fixed dollar stops, later we'll talk about the trailing stops. So basically, what you do is whether using a fixed dollar or percentage price, is you sort of determine that particular risk level, okay, before you even go into the market, right? And the third, you have what we call technical stops. And these stops are basically based on charts or technical indicators. Later, I'll show you the ABC trading strategy stops. That is actually a technical stop. But the technical stop must also come within the fixed dollar or percentage of price stop. Okay, as we said here, the guideline for having a stop loss is where the loss does not exceed 2 to 5% of your account equity, right? So even if you take a technical stop, it should be within that 2 to 5% of your, not exceed the 2 to 5% of your account equity. Okay, so let's look at placing stops using the ABC method. Okay, for those of you not familiar with the ABC method, just go back to modules 2 and have a look at that. But these are where the stops are. For buy signal entry, you place an initial stop at 1 tick below A. You will see a diagram afterwards to make this clear. If the A stop is too far, place a stop at 1 tick below C. Okay, this may look unfamiliar for those who didn't follow modules 2, but later we will see in the next chart in the pictorial form. For sell signal entry, okay, this is if you are shorting stock CFD. Currently, the feature is not available, but just for completeness, for sell signal entry, you place your initial stop at 1 tick above A, and if A stop level is too far, you place a stop 1 tick above C. Okay, so to make it clear, let's go to the next chart. Will make it clear. Okay, so in an ABC trade buy signal, where to put your stop? Okay, so last module we talked about the ABC buy, okay, where B is the trigger for you to go into the market to buy, which is 1 tick above B high, right? Now, after you enter the market at this level, okay, where the arrow is showing you, or here on the right side where you enter, where do you put your stop? Okay, you have two choices here. You can either put your stop at A, which is of course further apart, okay, from your entry level compared to C, which is the other alternative. Okay, so of course in terms of C, okay, it's closer and potentially there's a chance that you can be stopped out. Okay, in terms of A, what it means is when the market turns and go below A, that means the market is going to go on a continuation of a downtrend. Okay, we reviewed talking about in a downtrend, it's about lower highs and lower lows. So if it breaks A, that means it's making a lower low. So that is overturning the whole buy signal, right? So in terms of C, it's a tighter stops. Okay, it's if you review your risk and look at your risk that you're taking, you can determine whether you are using A and C. So later we'll look at some examples of using this. Okay, so we go back to our example which we use since the first module. Okay, this is Top Glove in the time period from January to February 2020. Okay, we looked at this the last module, and we had two buy signals here. Okay, which I label here buy one and buy two. But let's look at buy one first, right? So in terms of buy one, you had the B signal triggered over here. Okay, and then you have a C here, and you have an A here as well, or A here back here. So in terms of buy one, the stop loss, the first stop loss SL1 is basically almost the same level for buy one, right? So for example, if you take a buy signal over here, then you will put a stop over here. Now, before you even go into here to trigger your order into the trading system, you would recognize already if this particular buy points where I will enter the market, I will know my risk between this level and SL1 level, right? So you determine this particular risk, and from that you measure your risk and see how much exposure you can go into the market. Later we'll have a look at how to calculate that, right? So now market goes up. Okay, you have a second buy signal over here, which is the 483 level. Right, is that 483? Okay, and then you have a choice now of two stop loss levels, SL1 or SL2, right? So if you are more conservative, you do not want to give so much back to the market, you will put your stop at SL2, right? So market goes up, and you can see here it forms another ABC, right? And this particular stop loss, you will later, if you are trailing a stop, you actually put a trailing stop up here. You move your, if you took a SL2 stop, you'll move your SL2 stop to this level, right? And when it triggers, you will sell to take profit. Okay, we'll have a look at that again when we talk about trailing stops. So here we have another example. This is Top Glove, February to April time frame, okay, where we have two buy signals here, okay. One is A, B, and then it was triggered C, okay. So you either could have a SL1 stop here or SL2 stop here, okay. Now for buy one, if you took this A stop, of course it will not be triggered. But if you took the SL1 stop here, you'll be stop loss over here at this particular date. All right, you see that? Okay, so you have another continuing buy signal over here at 627. Okay, and you can also now choose, should I put my stop here at SL2 or should I put SL2 here? This is a question mark, right? So you gauge your risk from your entry point to this level. If it's too far, right, which is, this is actually quite far, okay, it's around 525 and your entry price is about 627, so it's almost a $2 stop. So based on your position size and your risk assessment, you may not take the SL2 over here, you may want to take the SL2 over here, right? So this is how you choose between the A and the C's as your stop loss. It depends on your risk and your position that you have. Okay, another example over here. This is Top Glove in April and June. This one we saw as well. It extends actually to July, right? There is this buy over here, which we discussed the other day, which is a level of about 1580, and then you have a stop loss around the this level is about 15 or slightly below that, right? So you can have either a stop here SL1, or you can even have a stop over here. This is the A stop and this is the C stop, right? Both of these both of which stop loss was not triggered and market continued to move up until today. Of course, last 2 days have been very volatile for rubber glove stocks. Right. So I hope that is clear in terms of where you put a technical ABC stop. Okay. Now this is a ABC trade signal. If you are selling, if you're shorting the markets, I won't spend too much time there, but the principles are the same. It's just the opposite of the if your trade signal is a buy signal of where to place your stops. So I won't delve too much on this. You can it's basically overturning or just opposite of what the ABC stops for buys. Okay, let's talk a bit about profit taking. This is a very important part as well. This is where you put your money in the bank, right? So a systematic profit taking strategy is important as well because this helps to fight the emotion of greed, all right? So, and it's if you are good at taking profits, a lot of people take their profits a bit too early, unfortunately, right? So in terms of taking profits, the sort of a rule of thumb, okay, is it should be 2 times the risk that you take, right? So that's the rule of thumb among the traders. They want to achieve 2 times their risk that they take. So if you usually take a 50-cent risk, you would like to have ideally 1 ringgit profit or more, right? So in terms of profit take exits, similarly, there's a fixed dollar, there's a percentage of price stops, there are technical exits, and there are trailing stops. Right. In terms of fixed dollar ringgit exit, is very similar to the stop loss. It's basically based on the ringgit size. So, for example, if your target size of 10 ringgit, okay, is your profit taking, is calculated so that if that particular target is hit, the profit will be in terms of 10 ringgit per share. So, if we look back at the previous example of a 5 ringgit fixed dollar ringgit stop, okay, your profit is 10 fixed dollar stop. So basically, you're trying to get a 2-to-1 ratio in terms of your profit against your loss. Right. In terms of the percentage of price, similarly as in stop losses, is basically a percentage set on the entry price above or below the entry price for long or short, depending on whether you're buying or selling. For example, if your entry price, if your long is 25, and a 10% target you want to place, that means if you make 250 on this particular stock CFD, you will exit, right? So you can have both the fixed dollar and the percentage price stop. You can, of course, have a technical profit exit as well. Okay, these targets are based on charts or technical indicators. Some of you who use things like Fibonacci extensions and all that to get your price targets, you can use that as well. Right. In terms of trading stops, is quite an important concept. If you are able to use that, yeah, this is a matter of trying to maximize your profits to let the market run for you. And what it does is, as the market continue to move up, okay, you continue to move your stops accordingly upwards, right? So basically, it's moving of a stop order, either set at a defined percentage or dollar, depending on what you are using, away from the current share price market or current market price of the shares. So let's say, for example, you're having a $1 protective stop loss. So once the market goes for you, say for example, it's gone up for you 2 ringgit in profit, you'll move your stop loss gradually upwards as the market continues to move outwards. So you trail your $1 stop so as to ride to the maximum of the price movement. Okay, so that's a protective, that's profit taking exits, right? So we've looked at the stop loss and profit taking. These two are the exits. Now, in terms of looking at the exits, if the trade is not going anywhere, a normal guide is this. If you, let's say, for example, if you are holding a position that already it's 10 to 15 bars, the market is not really moving. Let's say, for example, if you are looking at the daily chart, and for 10 trading days, it's it's not moving, you might want to consider whether that particular stock is something that you want to continue to hold that position or not. Okay, unless you know that there are some particular developments that are coming in that particular time frame. But as a rule, if you have like 10 to 15 bars from your trading chart time period, you want to consider whether you want to get out of the position, so that you can put your capital into in the, what do you call that, another stock CFD that is actually moving, right? So that's in consideration of a stock that is not going anywhere. So now we come to a very important topic, which is how to right size your exposure on your trades. Okay, so this is a very important concept. Okay, it can be a bit dry, okay, because a lot of it is mathematics, but let's run through the basic concepts of money management. Okay, money management, one of the most important thing is position sizing. Okay, and position sizing is basically how big or how much exposure or how much capital is at risk on a particular trade. Okay, and that factor is mainly determined also by your stop loss, because the amount of risk you take is also related to your stop loss, right? The other two factors that people usually measure in terms of money management is your profit factor. Okay, and basically is your trading system or your methods ability to generate profits over losses. So we were talking about just now wanting to have a profit that is 2 times that of your losses, right? So the profit factor, basically, if you can achieve a profit factor, okay, if you log your trades and record your trades, and you see in the long term you get a profit factor of 1.5 times or above, this suggests that actually your method is or trading system is very, very robust, right? So profit factor is a very important measure of your system. And the third measure is the percentage win or profitability. This, a lot of times people measure this and say, you know, my particular system or my method has a 70% percentage of winning. They always talk about this, about methodology and how accurate or how profitable is that signals that the method gives you. A lot of people concentrate on this, but interestingly, you actually don't need to have a system that is 80%, 90% accurate to make money. And we will see some of these concepts in the next few slides. So I want to show you a case study. This is one of the interesting books. This results is from Ryan Jones. As you can see here, I've quoted right at the bottom here. This is from his book, The Trading Game, Playing by the Numbers to Make Millions by Ryan Jones. It's a book about money management. And inside the book, he showed one of his trading systems. And these are a tabulation of his results, combined results for all 8 markets, because he trades many markets. He trades FX, he trades commodities, he trades bonds, and all these 8 markets he combined. We just want to have a quick look at the statistics, right? So net profit, don't worry about that. I want you to concentrate on 2 things. The win percentage, we're talking about the methodology's win percentage. And for Ryan Jones' system on the 8 markets is 57%, right? So it's slightly above 50%. Okay, and his win-loss ratio, which is basically his average win in terms of money and the average loss in terms of dollar value, it's 2.8 times. So this is very, very robust, right? And the rest of the measurements are drawdown, profit factor. Profit factor, again, 3.9 is very, very good, right? So I want you to concentrate on these 2 figures and come to the right side of this table, okay? And let's look at how you measure a good system. How do you define a good system, right? For a break-even system, winning percentage 50%. That means half the time you're losing, half the time you are profitable. And then win-loss ratio of 1. That means you win 1,000, you lose 1,000. Okay, this break-even system, actually you don't break even, you actually lose. Okay, the only winner in this system is the broker, okay, that takes commission from you, right? So if you have your numbers, or you see your numbers, win percentage 50%, win-loss ratio is 1 to 1, then you know that you are feeding your broker. The broker is very happy, but you're not making any money, right? Now, what is a very good system? How do you define a very good system? And this very good system is basically an average of those top traders that you have, win percentage of 40%. Okay, top traders interestingly have a win percentage of 40%, and they are top traders already, and a win-loss ratio of two times, right? You see where we are talking about the making $1 or making $2, and then your losses is 1. So your ratio of 2 to 1. So this is a very good system, and an almost holy grail system, right? What is a almost holy grail system? That means this system is so good, right? The win percentage is 50%. This is very interesting. We're not even talking about 70%, 80% here. Okay, and the win-loss ratio at 2.5 times. Okay, this is what people would consider the holy grail, right? So if you look at your trading records, and if you are notching up this kind of numbers between the very good and almost holy grail, you should be actually very, very happy because you have a very good trading system, right? Now, if your numbers are not like that, if your win percentage, especially this particular figure, you need to look at the win-loss ratio, your average win in dollar terms and your average loss in dollar terms. And that's where the formula goes wrong. And for a lot of traders and investors, they win a little, they take their profits very fast, okay, but they hold on to their losses, okay, and that's where the problems lie. And especially in a leverage trading like CFDs and all that, you can't do that, okay. So let's go on. Let's talk about a quick thing about martingale and anti-martingale. Okay, these concepts are about how you position size. Martingale is something that very common. This is you increase the positions as you lose, and increasing exposure and loss. There's a lot of investors do that. Basically, they double down when they continue to lose. They buy more, right? So in terms of long-term trading, this is a recipe for disaster. Okay, example of a sequence 1, 2, 4. They buy 1,000 shares. If it goes against them, they buy another 2,000. Goes lower, they buy another 4,000. So this is not recommended for trading, especially in leveraged products. Okay, what you want to use is what we call the anti-martingale concept. Is you only increase your exposures as you make money, up as you win, and down as you lose money. If you lose money, you reduce your position sizes. Right? And this concept is about achieving geometric growth, right? Earning profits more than what can be achieved on a single contract. So if you're just trading fixed sizes, using the anti-martingale method of increasing exposures as you make money, you will have a better growth in your account, right? So this is optimal for trading, and depending on your account size and your growth expectancy. So for money management guideline for CFD trading, first thing is remember preserve capital. This is the most important thing. Okay, the key to survival and prosperity in trading is have your stop losses, preserve your capital, always trade with a stop, risk no more than 5% of your trading capital on a trade at any one time for every single trade. Okay, don't have a position that will risk more than 5% of your equity. Calculate your risk and reward ratio, aim for a profit factor of 2 or more. Okay, use position sizing, but you increase your size in profits, okay, and decrease size in losses to ensure geometric growth. And this is the guidelines for trading CFDs. Okay, so one last example to show you. Let's say, for example, you have 100,000 in capital, okay, and you're saying that I want to have a fixed percentage money management of 2%. So for any one trade, I shall have only a max loss of RM 2,000 ringgit, right? Because 2% of 100,000 is 2,000. Okay, so I want to trade top glove. Let's say, for example, this example in 21st of January in 2020, you like the rubber glove sector, and you wanted to go in and get it, and you started with a capital of 100,000 to trade stock CFDs. So in January, okay, you had a entry price here at B2, okay, which is 485, and you have here a stop loss SL2. Okay, you decided to take a stop loss at C -1. You had a stop loss price of 455. So what is your risk here? Okay, your potential entry, okay, if you go in, it's 485, and your stop loss it's 455. You have what we, okay, let's see what, yeah, you have a 30-cent risk per share. Okay, so this is technically based on your ABC system. You have a 30 cents risk. Okay, how many shares do you buy? Okay, so your maximum risk is 2,000. You have a stop loss, single your specific trade risk is 30 cents. 2,000 divided by 30, you get 6,600 shares. Okay, and you round it down. Of course, it's you round it out to 6,006, and the value at that time is 4.85. Your entry price, the value is 32,000. Okay, this is the notional value of the shares you're trading, and in January, your margin for trading that is 3,201. All right, so this is how you calculate your position size, right? So for that particular risk of 6,006 shares at 30 cents, your max risk is at 2,000 ringgit. Right, so this is how you use position sizing. Okay, let me take some questions here. Okay, for those of you who have questions, please type it into the chat box.
Yeah,
Right,
if
risk and money
every one of
management.
you have any questions, please leave your question into the chat box. Yeah, you have one question here, David. The first
Yes.
one is, can you comment on Kelly criterion?
Oh, Kelly's criterion. Okay, Kelly's criterion is a very interesting criterion. It's used for what do you call that? Finding the optimal exposure. There's a lot of debate on Kelly's criterion. Also, part of it I also forgot because it's one of those things that we go through. They feel that Kelly's criterion may be a bit too aggressive, right? Because based on the 50-50 a probability of success in your trading system and a 2-to-1 return, I think you're supposed to risk like 25% of your equity at any one time. So Kelly's criterion, I think most of the people who use Kelly's criterion would have used a modified version of it because it tends to be rather aggressive, right? But if you match it into a game, let's say for example, a lot of people use this example where they have a coin toss, 100 coin toss, then 2-to-1 risk reward ratio, a 50-50 what do you call that, chance, because toss of coin basically in 100 throws you have a 50-50 probability. The Kelly's criterion will return 25%. That means the optimal exposure at each trade is 25%, if I remember correctly, right? So that seemed to be opinion of a lot of people that is rather aggressive. But Kelly's criterion set the motion for a lot of people to look at money management more seriously, okay, and where and what level should you put your exposures at. I hope that answered the question. Okay, to me, if I'm going to a casino, maybe I use Kelly's criterion. For trading, it may be a bit too aggressive. I hope that answers your question.
Okay, thanks, David. Due to time constraints, so if you have any question, then we will take one more questions.
Yeah, one more question.
Okay, we have one question here, David. So when the stop loss is set, do we need to wait there?
Sorry, do we?
Do we need to wait there?
Okay,
Meaning
let me
that
try to
do we need to wait? Yeah, meaning that do we need to wait?
wait for it to trigger. Okay, never mind. Let me try to see how to understand the question. Okay.
Yeah,
So
the attendees that the attendees who asked this question, he answered yes.
Okay,
But-
so
mm,
once you put your stop loss there, and markets will continue to move, right? And normally for me when I'm trading, I will look for any what is the next opportunity for me to move my stop. Okay, especially if the markets move in my favor, right? I will slowly move my stops upwards. Okay, that means as the market goes in my favor, I will reduce my risk of loss. Okay, meaning I will move up my stop. So my stop will not always just stay there. I will look at the conditions and I'll look at the ABCs and as it develops. If let's say, for example, if I'm buying, okay, and then the lows continue to go higher. Let's say, for example, I put my stop at ABC, the C level, right? So if I can find the next C level or next new what do you call that higher low, I will adjust my stop dynamically, right? So I just won't just sit on a particular stop, okay, and wait for it to trigger, because sometimes it's the market goes for you, and then you're actually making money, and then it comes down and take you at your stop level, which is a loss. That's actually very heartbreaking, right? So the chance, if you see your ABCs moving forward and you can find an opportunity for you to put the next technical stop, then you should move your stops higher. And one of the things I do as well, if let's say, for example, I'm able to market surges. Let's say, for example, I go into the market, I put my stop, and then the market starts to really run, and then I already achieved two times my targeted stop loss level or risk. I would actually at least move my stop up to break even, right? So that if in case the market moves back down, swing down equally fast, then I don't actually have to take a loss for that. I'm just at break even. So that gives you the psychological comfort. Okay, as you move your stops up, you're actually going to a position that is the risk or the loss is getting smaller and smaller. I hope that answers your question.
Okay, thank you, David, for the answers.
So yeah, there is one thing I just wanted to say. There is, I think, a CFD Bonanza campaign, which Hui-Chen reminded you at the beginning. So you can actually, look at the CFD Bonanza. Is a special offer for those who are starting out to trade CFD. So Hui-Chen will talk through to you on that. Okay, so I pass back to Hui-Chen.
Okay, so if you have any questions, to contact us and we are happy to assist you. Last but not least, to check out our CFD promo and grab the opportunity to join it. If you had missed our previous CFD webinar sessions or you wish to watch again, you may visit our YouTube channel to watch the recorded webinar. With that, I will end the session today. Thank you everyone for your time to join our webinar, especially if you have joined our all 3 CFD modules. And also many thanks to Mr. David Law for his insightful sharing throughout the CFD webinar series. Good night everyone and see you.